Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I want to get into these tax forms so we can familiarize you with those. The first one is your 1099 miscellaneous. Now, this is the one that mainly has to do with folks that are paying rents or receiving royalties.
Right. You have a rental property, you have a management company, you'll be looking to receive one of these in January. Remember, everybody should receive them by January 31st, your miscellaneous or your 1099-Rs. So box one would have how much rent you collected. Now keep in mind, if you have a management company, they better give you a report also, because their fees will be after this. This is 100% of what was collected in rents, not after their fees and everything. So you'll need to itemize your Schedule E's on that situation. Also, miscellaneous income, maybe you've got a small job. There's a lot of people are driving for Uber and things like that. You're going to have a form similar to this that you'll be receiving for how many miles that they paid you. So you'll be getting something 1099K, but you'd be looking for something like that. I have a lot of people that they don't need the money, but they really enjoy driving for Uber and those. So it's just something to do on that. And if you have a court settlement for health care or any of those kind of cases, you'll also receive something like this.
So be watching for 1099. Now, the one you see more frequently is the next one. This is just called a 1099-R. All right, now the 1099-R, this is the one when it comes to doing Roth conversions, when it comes into the more
any retirement you have, basically, or distribution you receive, right, from a retirement.
Whether it's a Roth conversion or just taking money out of your IRA for income purposes. So yes, exactly, requirement of distribution. Now this is what minimum distribution, excuse me. So the IRS, right at age 70 and a half, we've talked about this before, if you take money out of an IRA before 59 and a half, guess what? You're going to get one of these, and you're going to have a 10% penalty in addition to it being taxable income. Right. And in box one, it's going to show what that distribution was, and then it's going to show the taxable amount. Right. If you're over 59 and a half, let's say you're taking money out of a Roth IRA, or actually even before it, and we're going to get into how this works on Roth, but if you're taking money out of a Roth, you'll see the distribution, but the taxable amount would be zero then. Be careful too, because sometimes I see this with pensions where you'll get a gross distribution that'll show an amount, and then it'll say not determined or something like that in the taxable amount.
And a lot of people will put zero in that dollar amount, thinking that since they're telling me it's zero because there's nothing in it, that it will end up, and then we end up with some big problems. Because normally what you're going to see is something in box one, that would be the gross. And then normally in box five, you're going to see the portion that was maybe your contribution in the case of a pension or something. And then the difference would be what should be in box two, for example. You'll also look in box seven. That's a really important box for all of you, because this is the one where Hank more than once has found that box to be incorrect when he brings his clients in, because it will either be marked 1 for early distribution, box 4 for death benefits if you've inherited an IRA, box 7, which is a standard deduction, or a box G, which is what we're often looking for a rollover, which he'll get into in a minute. And then obviously if it's from an IRA, it should be checked or not on that box next to it. But that is a very important box. If it's mislabeled, the IRS doesn't care what we say. If I file it as if it's not an early distribution, but if it says early distribution, you're going to get the love letter. They don't care this has to be corrected. If not, you're going to have some fun.
And that's what we do. A lot of times we'll go in, and if we see an error, we're looking. When it comes tax time, for my clients anyway, the clients that I assist with their taxes, I go over these things with them. All right, we do tax planning. That's why I like to do reviews. And at tax time, when we're setting up, we'll set up 3, 4, 5 days sometimes in a year where I'm meeting with Dr. Friday around tax time alone, not to mention the times that we meet with clients through the year, because tax planning is so important and errors are so common. The custodians, the banks, the broker-dealers, the financial institutions that send these reports out, guess what? They're people. They make mistakes, and we want to catch those mistakes so they don't end up costing you. So if they send it to you, remember, a copy went to the IRS. Right. So if yours is wrong, the IRS's is wrong, we have to go back to the institution. We have to have them correct that, send out the corrected 1099 to you as well as to the IRS, and then we take care of it as far as your tax return goes.
It's well worth filing an extension to get this filed correctly with the institution versus sending it and hoping that you can correct it with the IRS. It takes a lot longer to correct something with the Internal Revenue Service than it would be to extend taxes and correct it in the first place. And last year we must have had 6 or 7 mistakes that we found in just a couple days of meetings.
And here's one of the things to look at as well. When it comes to Roth conversions, there's a lot of ways this can get mixed up. You'll get a taxable gross distribution. It'll show taxable amount should match up to be about the same. However, all right, there are times with these Roth conversions, there's another form, 54, I always get this mixed up. It's either 5468 or 5498 or something like that. But in either case, it's a form when we do a Roth conversion that has to be filed with the IRS. And the reason this is very important is there are limits of how much money you can contribute to a Roth IRA, okay? And when I say that, listen to my language. Contribute to, as in I'm opening up an IRA or I already have a Roth and I'm adding money from based on my wages. I can put either $5,000 or $6,500 if I'm over age 50. A Roth conversion, though, I could do $100,000, $200,000, $500,000. I can convert as much as I want in a given year. But if I don't report it and it looks like I just tried to put $100,000 into a Roth, the IRS is going to say, wait a minute, what happened here? Yeah. You can't put that much in. They're going to, create all kinds of penalties and things for you. So we have to show, no, we didn't make it as a contribution. We did it as a Roth conversion. Okay, understanding that. Next, sometimes with a Roth conversion, we do the taxes and we find out things got triggered. Now, this has happened where new clients come in and they say, hey, I did this Roth conversion and I've got all this extra tax. What happened? And I'll look and I'm saying, well, you shouldn't have done that much on the Roth conversion. Right. So whoever was, advising you at that time didn't go through the process of making sure in advance what your taxes were. So things got triggered that wouldn't need to be triggered if we reduced it. In that situation, we have until October 15th of the year after that tax year. So example, if you did a Roth conversion this year, we'll have until October 15 of next year, 2017, where we can do a recharacterization and fix that problem. So this is one of those that can be fixed. Some other things that are going to happen there when it comes to Roth is understanding, again, when we're looking at that 1099, making sure it's done right, making sure that 54, 68, 98, whichever form it is, making sure that gets filed and that we have a copy of it, okay, for your tax return to keep on file, to make sure there's not going to be any surprises there. And also understanding, by the way, when we get into strategies, some of the impacts that you can have, we talked about alternative minimum tax. Taxation of Social Security is another, and this is where tax planning comes in again. When we sit down, we're talking about the forms and stuff at this point. Something to understand, when we do, if it's done correctly up front, less likely to have a problem down the road, other than these little occasional errors that are easy to fix. But here's an example. If I do a Roth conversion, I want to make sure, all right, if you're collecting Social Security, it could if you're not paying tax on your Social Security, or if it's going to bump you up, usually as a rule of thumb, if I can do Roth conversions and stay in a 15% bracket, that's the ideal situation.
Absolutely.
Because I figured your taxes are never going to be lower than 15%, right? So we've got, for a married couple over 65, that gives us up to close to $100,000 in income, basically, that we have to work with. So if your income is coming in short of that 100, we can use that difference. Say you got 60, then we could do a Roth conversion on 40. Now there's some other things that we get into with that. This comes into balancing out the Social Security part. Right. All right. It could be that you could cause so much of Social Security, 85% of your Social Security benefits all of a sudden become taxed. What we thought we can convert, all of a sudden at 15, we're pushing up into a 25% bracket. Totally changes everything, and we're paying 25% on something we only need to pay 15 on. We need to back up that conversion or ways that we're taking in.
That also can affect your Medicare, your payments that they take out, because you could kick yourself into a means testing and a little higher payment every month from that. So you got to be careful. There's a few other things you could trigger, because I've had a couple clients say, well, I'll just bite the bullet. Let's just do it, right? And you're sitting there going, it's not any easier to do it at one time and pay probably two. I mean, Hank and I have more than one scene where if we did it at one time, it would have cost, 3 times the amount if we spread it 4 years over a period. Besides the fact that they do get hit with their Social Security benefits, or at least their Medicare side of it, they end up getting it higher for a whole nother year, which often costs them more money. So you just got to basically pay attention before, just because a lot of times people get so excited about the whole concept of having it in a tax deferred, growing, or doing something else with that money, that they miss the whole point that you don't have to do it instantly, that instant gratification doesn't have to happen.
That's it. We've talked about it before when it comes to like people pulling money out of a retirement account to pay off a mortgage or to pay off some debts.
That's why he's bald.
You can do that.
It just kept pulling his hair out every time I had it.
The hair was going well before that. But when it comes to doing the planning part, just think of it. We're going to accomplish the same goal, okay? But instead of doing it 1 year, maybe 2 or 3 or 4, we'll run it those different scenarios and see, okay, if we did it this way, this is the total tax paid. If we do it this way, total tax paid, and so on, all right? So that we come up, then we can look and see, well, what's going to give us the minimum tax bite? Do you want to pay more in taxes, right? Is there any reason whatsoever to pay more in taxes than you have to? Wouldn't it be nice to keep that money in your pocket, in your bank account? Well, you can do that with just taking a little extra time and doing the planning, and that's what we do. We want to see what the impact is going to be on the decision that we're looking to do. So it's a first thing, someone comes in, we're talking a Roth conversion, that's one of the things I look at. Someone comes in and we're talking about how to take income that they need for, to supplement their income in retirement. So for instance, your standard of living, your quality of life, the amount of money it takes each month to maintain that, we take a look at that and then we say, okay, I need to take income when I retire, right? The wages go away. I'm going to have Social Security. Maybe I get a pension, whatever it is. For most people, maybe they need some extra money, right, coming out of the retirement accounts or out of savings and retirement. We're going to balance all that out to minimize taxes. We'll talk about some of those strategies here shortly, but first, a quick break. All right, so when we come back, we're going to get into more tax strategies, income planning, how to minimize taxes on those IRAs, how to minimize taxes in general. So join us here. We'll be right back on the Retirement Report.